Long-short equity funds look interesting in the current market environment in my view. Simplistically, the wide valuation dispersion within global markets, as in the historically large spread between the most richly and most lowly valued companies in the market, presents an attractive backdrop for strategies looking to generate returns through both investment long and selling short. Following a strong above-trend run in markets over recent years, we also see an attraction to seeking out strategies offering a lowly correlated return profile. Killik Co's alternative allocation investment strategy actively looks to curate a portfolio which includes a range of assets and often a suite of risk-controlled fund holdings with the ability to hedge or diversify broader market risks and produce returns in a range of market environments. This often includes long-short equity strategies. Chris Reid is a manager we've thought highly of for many years, and following him co-founding the asset management firm Iguana Investments in 2019, in today's episode we were delighted to sit down with him at head office and explore how he's developed and evolved his approach on his own long-short equity strategy. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this week's episode, we were joined by Chris Reid, Chief Investment Officer at the boutique asset management firm Iguana Investments. Having previously been a highly rated sell-side analyst at Credit Suisse and Deutsche Bank, Chris moved to Majedi Asset Management and co-managed a number of the fund strategies there, including the long-short equity Majedi Tortoise Fund. Chris was also the lead manager of the Majedi UK Income Fund from its inception to 2018, running that strategy very successfully during that period. As we discussed in our interview, Chris then took a step away from portfolio management to complete a Masters in Finance course at Cambridge before coming back to the industry to co-found Iguana Investments in 2019. Chris is one of the great characters in the UK fund management industry, in my opinion, and I was delighted to have him join us and take part in the Investor Insights series. All through his investment career, he's always spoken very passionately about his work and takes a very thoughtful, intellectual and prudent approach to investment, which I hope comes across in my discussion with him and is evidenced in the developments he has made to his process since founding Iguana Investments and launching the asset manager's long-short strategy. As always, we hope you enjoy the conversation and please do get in touch for further details or explanation on any of the topics discussed in this interview. Chris, delighted to have you in the office today. Thank you so much for sparing some time for this. How are you doing today?
Great, thanks, and thanks for having me. Yes, feeling great. Looking forward to your questions. Brilliant.
Good stuff. So we've got this kind of standard opening question that I think we've asked everyone on the series, and all it really aims to do is get a bit of an insight into how you go about things, a bit of an insight into you, really. So I wondered if there's a kind of anecdote from a recent meeting you've had or trip you've been on or a research project you're doing. We've had kind of book recommendations in here as well. Anything you can kind of share to kind of give us a bit of an insight into you?
Yeah, well, I think sort of probably more on the work side. We work quite closely together as part of a team, so we often go off and find pieces of information. And I think we had a meeting with the this guy that works in defense, and he was telling us about the problems at the moment in the defense system is that everybody thinks you need expensive pieces of kit to sort of prevent a war, but actually all these pieces of kit, the most useful pieces of kit, are the small drones, the small weapons, and they're really what you need. So that's actually changed the way we think about defense internally. We were more focused on the big companies with the big submarines, etc. And we've really started to look at, companies that are producing sort of small, cheap, useful pieces of kit. And that was just an off-the-cuff remark, really, in one of the meetings we had.
Yeah, no, really interesting. Yeah, thank you for that. So, Chris, I think a number of listeners might be reminded of you from your days at Magedi. And in fact, I was looking back at the archive of our kind of Meet the Manager series 11 years ago. You might not remember, but we actually did an interview on UK income back in the day. So some I'm sure will remember you from those days. But I wondered if I could ask you to summarize that kind of prior experience, and also kind of what led you to come and co-found Iguana, was in 2019, just kind of the backstory, really.
Yes, 2019. Yes, I remember well, 10 years ago, less grey hair then. So I think my background, really, I joined the financial markets in London 2000, and really it was a consulting background. I came from helping companies sort of change, and that was really something that I think was I've tried to carry through in my sort of city career. So I spent then 8 years as an analyst, sort of learning the trade, the details, the decimal points, and that was in sort of European airlines, and worked for some really good people, clever people, and then after that, back in 2008, joined, as you said, a company called Magedi Asset Management, which at the time was kind of a startup UK investment boutique. Worked there for nearly 10 years across 3 funds with some amazing people, some real investment geniuses, with all different personality types. And then sort of ran my own fund actually for 6 years in that time, the UK Income Fund, that did quite well. But I think really getting on a little bit into my mid-40s, I felt needed to draw a breath, go back to university and just sort of learn a little bit about what was happening. I felt that I was there'd been a lot of changes in the financial markets. I operated value strategy, and it just felt a bit like I needed to sort of modernize my thinking. So I spent a year at Cambridge just learning about really sort of quantitative analysis and sort of, should we say, upgrading my skills, getting a bit of energy back. And we always kind of wanted to set up our own firm. I think I really enjoyed Magedi being a fund manager, but we just felt that if we had a sort of a really focused firm where we could really sort of, there was a direct line between the clients and sort of the firm, that would be really putting ourselves out there to make money for people, and also just the felt that sort of there was room to change the sort of to improve the value investing style. And we also wanted to sort of give something back a little bit. So at the Iguana, when the business actually makes money, the idea is to give 10% back to sort of wildlife research charities. So it was just a combination of factors really that led us to set up the firm, but really just to try and focus on, just have that sort of small firm ethos, focusing on making money for clients.
Yeah, absolutely. I was going to ask you why Iguana, but you've answered that in the kind of giving it back. But yeah, thank you for that. We'll also maybe come back. I wanted to touch on that kind of new kind of quantitative process that you've introduced, but I do want to spend some time on the investment process, and because you do, we remember from the Magedi days, take quite a kind of a unique approach to kind of how you kind of come up with a portfolio. And one of the key elements that you describe on the Iguana Fund is this focus on transformation investing. So I wondered if you could kind of talk us through what you mean by that, and what you're kind of trying to uncover with that sort of analysis.
Yeah. So transformation investing, I think, is pretty simple. We're just looking for businesses that are sort of really changing dramatically in some ways. So the operational changes, strategic changes, or sort of even a kind of a market change. So it's almost as simple as that. So, we're not interested really in sort of, businesses that the market has already discovered to be fantastic over hundreds of years. That we're really looking for these kind of good to great type businesses where they've been sort of, they've got something that that could make them special, but they haven't quite unlocked it yet. Maybe they need to go on sort of a diet in terms of, cutting costs and getting more streamlined. Maybe they haven't quite got the product, or maybe the sort of management has become a little bit sort of, lost, a little bit less focused. So that's really what we're looking for. So I think that once you've got that sort of spark of an idea, and for us, that's really, we at any given time, we've kind of identified sort of about 200 companies that we think are having some sort of transformation. Then we get into the process a bit. But I think we'll give examples, I'm sure, in a minute. But for us, what we're looking for is effectively cheap companies that are changing in some way. And we have this 5-test process that kind of judges that. So it's almost converting an idea into an investment. It's almost like a quality overlay. So we're looking for, okay, this looks like a cheap company that's changing, but how much risk is in the investment? How much risk of permanent capital loss? So, what are they doing in terms of the management? Are they sensible? How do they make their money? What are they doing in terms of ESG? So are they sort of vaguely responsible, and are they trying to get more responsible? These are the kind of the tests we do. But the real core of it is just finding businesses that are changing.
Yeah, thank you for that. I do want to spend some time on this kind of quantitative tool that you've developed. So as you said, kind of went back to school and went to Cambridge to kind of learn about kind of data analysis, and this is kind of in addition to the process, I guess, looking at market behaviour and what's driving share prices. Could you kind of talk us through how that works and the importance that it kind of gives the process?
Yeah, I think you're right to focus on that, because really sort of 80% of our investment process is I don't want to say the same as other people, because transformation's different, but it's very similar. And I think the other 20%, which is this more quantitative analysis, is worth learning about, because I think that we're the only people that really do this. So at its heart, it's just sort of correlations, really. We're just trying to understand how company share prices respond to changes in sort of individual market expectations. So, what drives a share price most? Is it most driven by sort of sales growth? Is it most driven by sort of cash flow? Or maybe it's most driven by margins? And actually, it's almost trying to discover the groups of investors in the market that are looking for certain things and what influence they have on an individual share price. And that's really all we're doing. So if you look at some companies, we'll probably talk about this later, but I think Tesla is a good example. Tesla has lots of different groups of investors looking at the company, and they're all interested in different things. So when you try and sort of look at that under a sort of a quantitative lens, you just see lots of noise. So we would be reluctant to sort of invest in Tesla one way or the other. What we really want is one company, one thing, that's really driving that company share price. And that's almost like the perfect investment for us, because then if we know what that sort of thing is, maybe it's improving sort of sales growth or whatever it is, we can then sort of really take the guesswork out of value investing. And that's all we're trying to do.
Yeah, great. Yeah, I think that's really helpful in kind of setting the scene. I wondered if we could maybe kind of try and bring it to life even more and talk through a couple of stock examples, if I may. Could you kind of give us an example of maybe some stocks that really exemplify what you're looking for?
Yes. Well, I mean, it's funny when you start looking at sort of companies. It's probably a bit like you guys sort of X-ray portfolios and look at, value tilt, growth tilt. You do see that they're all kind of very different individual companies, and I mean, the market really is like the old saying, it's lots of individual company markets rather than one big stock market. So, you get lots of information. So, I mean, just to think of a couple. I mean, I mentioned Tesla already, where it's kind of like there's lots of things going on. But I mean, Carnival, for example, which is a holding in the fund, a cruise operator, it actually isn't really that responsive, for example, to oil price. So, if you see sort of the stock moving in the oil price, that's usually an investment opportunity. So it's not just what the company's responds to. It's also sort of what it doesn't respond to when you think it would. But I think there's a lot of them. I mean, in the UK, for example, the mid cap companies in the UK, they're often very focused on changes in profitability. So investors that invest in UK mid caps, they're often looking for sort of margin changes. So we've got a company called Hiscox in a portfolio, which is insurance, relatively boring company, but actually when you sort of look at it under this sort of X-ray of quantitative analysis, investors are very focused on them recovering their profitability, and that makes sense actually fundamentally, because a few years ago they really had problems in this regard. So that's one. I think also actually the US names. A lot of people think that the US stock market is just driven by kind of ETF inflows. But actually, the US investors are quite a sort of a canny lot as well. And you'll often see stocks that that are really quite well, should we say, understood. So I mean, it's not in the portfolio, but Apple, for example, Apple, when you sort of X-ray it, it's very driven by cash flow. You can really tell that investors know it's a big company, mature company. It's just driven by sort of how's their cash flow expanding, what are the prospects. There's not really a growth factor in that stock anymore, which sort of surprised me, but actually makes sense logically. And yeah, just to maybe pick on the last one again, we actually do have this in the portfolio, which is Meta. Meta is a share price, obviously Facebook. Investors are very worried, I think, about the growth prospects of that name. So actually, a lot of the share price depends on revenue growth prospects, and if those start to accelerate, and in fact, that's why we have it in the portfolio. We think that it's going to be one of these companies that is going to see accelerating revenue prospects from AI very quickly. Then you should see the shares really responding in quite a dramatic way. So it's just explaining what's happening in the share price moves. That's all we're trying to do.
Yeah, no, thank you for that. Some really interesting examples. Thanks. I mean, looking back at the last kind of few years, it's been a market which it's had a number of kind of macro top-down events which have really impacted markets. So yeah, I think you made it very clear that kind of fundamentals are a big part of what you do. But are there any kind of general themes to the broader market outlook that's kind of driving positioning at the moment?
Yeah, right at this moment. Well, I think I mean, we're not a theme investor, and I always think it's sort of hard for me to. You can almost open the FT and you'll probably come up with more insightful stuff than listening to someone like me. But yeah, I think it's the two things I'd say is there is a lot of. I mean, there are a lot of sort of very clear themes established now. The deglobalization theme is obviously happening, and to some degree, I think it's well appreciated by investors that we have so much debt now that really the sort of the currency debasement trade is a real thing, probably much more so than in the past where it was very niche. So for us, for example, we've owned sort of gold miners for the last 18 months, and it has surprised me how much the trade has caught on. But actually, when you look at the reasons for it, they're really valid. So I think the sort of things that you're thinking, whoever you are listening to this, you're probably thinking the same. We don't have any sort of insights, the people who are investing in the market, to add to it. But the one thing I would say is that actually this is often overlooked by people, that the corporate sort of life is actually fairly stable. I think that a lot of these big companies now, they've been through a lot. This is also true in the UK, and they kind of know what to do to manage that situation. So we feel that, if you can look at some of these sort of previously disliked sectors which maybe are sort of beneficiaries of deglobalization, and that you'll usually find quite good quality companies in it that are having quite a steady time of it, even though, the news flow sort of constantly bombarding us. So the corporate life is a lot more stable, I think, than people let on. And that's something we try and remember in our investment.
Yeah, thank you. And so obviously this is a long-short equity portfolio, and I'm conscious that the long-short equity funds can come in quite a few different forms, lots of different shapes and sizes and risk levels. I wondered if I could ask you to kind of briefly describe what investors should expect from this portfolio in terms of its kind of profile, in terms of its net position, or how much risk relative to the market it's likely to take through time.
Yeah. Well, I think I'll give you some numbers in a minute, but I suppose at the highest level, what we're trying to do we're, rather than being one of these sort of exotic hedge funds, we're just trying to provide a sort of a platform to allow us to make money from stock picking in all market environments. So the kind of the long short angle is there to sort of mean that we don't get buffered around too much by all these sort of macro events. That means we've got a little bit of hedging if something very scary was to happen to a particular country or region. That's the way we think about it. It's just a sort of a a repository that will allow us to make sort of 8 to 12% returns a year from stock picking. Having said that, I think it is a long short fund. So we would be what's known obviously as a low net long short fund. We're typically the holdings of longs in percentage terms is about the same as the holdings of shorts. So we're not taking a lot of market risk. So we would have 25 to 35 longs. That's concentration on the long book. Maybe up to 5% of the fund might be in a particular stock. And then on the short book, we go for diversification. So no more than sort of 2% it's actually lower than that, but 2% of the fund would be in a particular short. And that's just really to make sure that if we do get things wrong, let's say we're short something and it gets bid for, we're not going to sort of, destroy the fund's overall returns profile. So I think those are the crucial things we focus on. I think that gives us gross exposure of 130%, which is relatively, I think at the low end of most hedge funds. You can see these hedge funds up to 300%. And then the net exposure, as I say, sort of 0 to 10%. So not a lot of sort of overall market risk. I think you sort of mentioned about risk, and we do spend a lot of work in it. I mean, this is the fourth fund I've been really involved with or managing, and the really making money is not that difficult. I've kind of made money in sort of all market environments over 15 years, but we do focus quite carefully in trying to do that with limited correlation and sort of limited volatility. So we have, in addition to sort of all the usual risk sort of constraints, such as stop losses, etc., position sizing, sector concentration, we also spend a lot of time working through firstly how the shares are acting in the market and whether there's sort of, should we say, something that we might not know. And then we also spend a lot of time thinking about what other market participants are doing, because that's a real source of risk, where, you can be quite comfortable in your own position. But actually there's lots of other people that are betting maybe the wrong way. And so that has a big influence in share price. So it's at its heart, it's just a simple vehicle to make for stock picking. But yeah, we do spend a lot of time just trying to make sure that we're keeping the correlations and the volatility of the fund to nice low levels as much as we can.
Yeah, no, that's very clear. Thank you. Chris, we've got a bit of time here at the end, actually, and we've got a standard final question to these interviews as well, and it hopefully isn't the kind of trickiest question, but it's the one that asks the speaker for their kind of highest conviction area or a part of their investment universe that they are particularly positive on at the moment. You mentioned a few areas already, but I wondered if there was kind of one that you would particularly highlight at the moment. An area or a stock?
Yeah, well, I think, sort of 6 months ago, I would have said sort of gold miners, to be honest, but that's much more appreciated by the market. So I think one area that we're pretty excited about is sort of pharma. So the US sort of drug companies. One of the reasons I went back to Cambridge actually was to try and I felt that I think there's a lot of people who sit in front of computers in London and they think they know what's happening in the world in terms of innovation. And I was kind of at risk of becoming one of those people, really. So going back to Cambridge, in addition to sort of meeting all the young people and learning a lot about the environment, I also sort of was able to sort of get a lot of information on sort of real innovation. And I think pharma is something where there's been unbelievable strides in the last 10 years. And yet, if you look at the sort of drug companies, because really the near-term news flow with Trump and his pressure on drug prices has been very bad, they're almost at sort of 20-year sort of lows. So I think this is a sector on a sort of a 3 to 5 year view is going to be one of the real standout sectors in the market, and it's just being overlooked because of AI, which actually is quite good for the drug companies, and because of Trump. I wouldn't want to. I could talk about individual companies, but the only thing I'd say is that often the cheap pharma companies are cheap for a reason. I mean, one of the other meetings we had recently was one of the pharma companies pointing out to us that you really don't know if a drug works because of the diversity of population that exists in the modern world. You really don't know until the drug works until you've put it through sort of 10, 15,000 people. So it's very difficult to extrapolate from the early stuff that it's actually going to work durably over time. And maybe we've seen that with vaccines. But, the bottom line is I think good quality pharma companies are massively underpriced in the stock market. And, that would be my tip for the next three to 5 years.
Chris, always really, really interesting to chat to you. Thank you so much for your time, and thank you.
Thanks, it's a pleasure. Lovely to see you again.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.